The secrets of life insurance. In this presentation, I'm going to explain how life insurance started, why it started. I'm going to cover the basics of life insurance. And part of the goal is to break the stigma around life insurance, which prevents a lot of families from actually getting the protection they need. So, a little bit about me. My name is Steve Compton. I'm the agency owner of Cornerstone Insurance Agencies. I've been life licensed since 2003. I'm a graduate of Ottawa University with a bachelor's in business. I'm a graduate of Gupton Jones College of Funeral Services with the associate in funeral services, and I'm also involved in several professional and civic organizations. I'm also a licensed funeral director and embalmer in the state of Georgia. I currently am the funeral director in full and continuous charge of a local family owned funeral home. And that is part of the reason I created this presentation. Like I stated, I've been selling life insurance since 2003, but there was a point of time in my career that I stopped selling it because I was getting to a point that I was doing a lot of educating, but the people that I was speaking with did not actually move forward in getting the protection they needed. So it wasn't until I got my license on the wall as a funeral director in charge of a funeral home, that I seen firsthand families being affected, negatively affected when they did not have protection at the worst time in their life. And so I made the commitment that I'm going to do my part on educating and aggressively teaching and selling life insurance. So that's the reason why I created this presentation, to break the stigma and to educate. So, what is life insurance? Life insurance is a selfless. You buy life insurance for those that you leave behind, not for yourself. The whole mentality, what's in it for me, is not the mentality of those that actually get life insurance. You're doing it for others. Life insurance is an agreement between you and an insurance carrier to pay a monetary benefit when you die. But the only way that an insurance carrier is willing to put up a large amount of money in exchange for a smaller monthly premium, something needs to exist. And that thing is called insurable interest. Insurable interest is you telling the insurance company, this is the reason why I want you to contractually put that money up in exchange for my monthly premium. Things like financial security. All that means is when I die, it will put my beneficiaries in a financial deficit because they're missing out on my income. Debt protection. You tell an insurance company, I have debt. If I pass away, that debt will be passed down to my beneficiaries, or my beneficiary like a spouse, we share debt, and so I want to eliminate that debt off of that person. Legacy planning. You're just telling the insurance company, I want to pass down wealth. I want generation to generation to have money, to have wealth. These are examples of the things that need to be in place in order to go into that contractual agreement with a insurance carrier. But wait, there's more. And so now we're going to dive in the secrets of life insurance. One of the earliest life insurance companies is a life insurance company called the Amicable Society for Perpetual Assurance. Now you'll see that ins- insurance companies back in the day love long names. This insurance company was started around 1706 in London, England, and it was started by and for wealthy white men. And so the idea was they wanted to create a society that they would contribute a monthly or annual premium that if one of them died, it would pass wealth on down to their beneficiaries. But the key was they wanted to keep their circle, their families in a certain in a keep their families, I'm sorry, in a certain elite class. And so they created this society that was only available to those wealthy individuals. And everybody else that was middle class, working class did not have access to this type of protection, this type of society that made sure that wealth passed down specifically to their generations. But there's a problem with these type of societies that was created in the early and mid 1700s. War exposed how demented and um, how that concept negatively impacted the general population. The Revolutionary War, 25,000 men died. Civil War, over 600,000 men died. World War One, World War Two, over 500,000 men died. I want you to think about this. Many of those men were married with children. So I want you to imagine how many men died and how many widows and orphans were created as a result of this number of men dying. And pretty much, if you look at it, a short period of time, late 1800s to the early 1900s. And so what you seen was an influx of orphanages during this time. And unfortunately, it was the church. It was the church that took on the burden of creating these orphanages to help these widows and orphans because there was nothing in place for them. There was no society. There was no life insurance. There was no program or perpetuated program to pass down that wealth for them because they were excluded. That was only for the elite. Then the United States government under Franklin D. Roosevelt created the Social Security Administration to help address some of this need. When somebody died and left their loved ones behind, left a widow and orphan behind, the government can step in. The challenge was it took a while for those benefits to actually spread across the nation. But the benefits, to be honest with you, just was not enough for that widow and those orphans to have a, a quality life. Another aspect that the Social Security Administration did, they created a death benefit around 1954. And at that time, the death benefit was $255. And around that period of time, the average funeral costed $700. So the United States government essentially covered a third of a funeral, covered the cost of a funeral during this time. And that was the United States government trying to address this deficit between the working class in the event that the breadwinner passed away, as opposed to those societies that only focused on the elite. The first idea I want you to understand that will help break that stigma about life insurance is that I want you to understand that life insurance is nothing but a club. See, in this slide, I have certificates from different organizations, different associations, different fraternal groups, different clubs. If you look at the lower left hand corner of the presentation, you will see a certificate. And that company is a company that provided fire, life insurance, and annuities. And so when you got a policy with this particular life insurance company, or pretty much any life insurance company around this time in the 1800s, they would send you out the contract and this membership certificate. And then I want you to look at the other four certificates. These are certificates that you get when you join a fraternal organization. See, the working class people understood that they did not have access to those elite societies that created a program to pass wealth down to generation in their inner circle. And so what they realized, since they don't want to give us protection to take care of our widows and orphans, then we're going to do it ourselves. And so you've seen the influx of these fraternal organizations begin to spring up around the late 1800s because they made a commitment that if they want to take care of us, we're going to take care of each other. And so when a war creates a widow or a widow and an orphan, or just life creates a widow and an orphan, we're going to make a commitment that when you die, we're going to take care of them. And so a part of the obligations, a part of the commitment that all of these organizations have, and those of you that are members of these organizations, you know that that is a commitment that if you pass, we're going to make sure we take care of your loved ones that you leave behind. The other thing I want you to understand to quantify that life insurance is nothing but a club. If you look in the lower right hand section of the presentation, you'll see that is a certificate, a member certificate of a Mason. So when you join Masonry, this is the certificate they give you to show your membership. Now, it looks a lot like the certificate of that life insurance company, the membership certificate of a life insurance company, because they are the same thing. Life insurance is nothing but a club. And it's a club that was started from working class people making a commitment to provide mutual aid for one another. What was the contractual, lawful idea that allowed those rich white men, those elite, to restrict the working class person for having access to their life insurance society? And that is insurable interest. See, early in the presentation, I told you in order for you to go into agreement with an insurance company to say, hey, I want you to put up this large face amount in exchange for my smaller premium, is because I have these things in place to justify that. But those elite societies legally was able to deny the average working class because they said you did not have insurable interest. So around that time, blacks could not get life insurance because they said you don't own anything. Many of you during the emancipation around the time that these societies and insurance companies were beginning to spring up, you can't get life insurance. You don't own anything. You don't have any debt. And we don't care about you passing wealth to generation to generation because we truly, really, really want to keep you as a substandard or um, a a sub citizen, a person that does not value or bring any value to um, our society. And so they justified it because you don't have any insurable interest. Women, same thing. During the time, 1700s, 1800s, even in the early 1900s, women were considered second class citizens. They couldn't own much. Everything was controlled and owned by her husband. And so if a woman tried to enter into one of those societies or even get insurance from those early life insurance companies, they were legally denied because they said she has zero insurable interest because she can't own anything. She doesn't have any value to society. And then even working class or middle class or poor whites, especially those in rural communities and rural communities, were denied from access to those societies because they said that yes, you do have some insurable interest, you have farmland, but it's not enough. And they also wanted to keep those whites in those rural communities as second class citizens or less than them because they needed people to farm. And so insurable interest is how they were able to uh, create this disparity between the wealthy and the working class and the poor. Here's another thing that clearly removes the veil between um, this greedy, truly demented idea that we're going to pass wealth only to our own and we're going to exclude everybody else. This clearly exposes um, what is behind that ideology. New York Life, which is a life insurance company that pretty much all of you know, New York Life was one of the early insurance companies that actually insured slaves for the slave master. The slave master was able to get a policy with New York Life that if that slave died, they would get paid the death benefit. Because that whole idea of insurability, meaning you would take a financial loss if something happened. So this slave had insurable interest because if they died, it would negatively impact the slave master because he just lost revenue. He just lost an asset. So the slave owner was able to get a life insurance policy through New York Life on his slave. Another example is Aetna. Aetna actually started as a life insurance company, but now they provide health insurance and health indemnity products. But they too would allow they would sell a life insurance policy to a slave owner to insure his slave. The reason why I bring this up is I want you to see how the elite was able to insure themselves to pass down wealth. Slave, black people, slaves, were not able to get insurance to protect themselves, but the slave owner could put life insurance on the slave. So it shows you that insurable interest existed. You can't get it, but we can put it on you because it benefits us. And that was the basis of life insurance in the beginning. But here's an example of the breakthrough. Here's an example that I said we couldn't get it from the elite, so we're going to come together with a mutual aid, right? We're going to take care of each other when we die. We're going to take care of our widows and orphans. So, like I said, women couldn't get life insurance in the 1700s, in the early 1800s, because they didn't own anything. They were considered second class citizens. And so there was a teacher that started a association, a fraternal organization called the Women's Benefit Association. That it was an association where women supported each other. They had benefits where, of course, that something happened to you, we'll take care of your loved ones you left behind. Um, they did socials, they did community service, they did a lot of education about um, domestic living, all those types of things. At one point, this association had 2,600 units or chapters, and eventually, because it was thousands and thousands of women that were in this association, eventually they created a true death benefit as a part of this association. So it wasn't just you a member of the fraternal organizations and we're making a commitment that we're going to take care of your loved ones. We're going to do that, but we're also going to cut a check. So now you are able to, um, your spouse is able to do more. He's not going to be as impacted financially because you're no longer alive. And so, as a result of that, she ended up creating one of the first life insurance companies called Woman's Life Insurance, which still exists today. One of the things that I want to point out, if you look at the publication on the right hand side, that this is one of the publications that highlighted the building of the headquarters. But if you look at the lower right hand corner of those four images, it's hard to see, but that image is a image that most fraternal organizations, whether it's Eastern Stars, Masons, Elks Lodge, they do an annual picture of that particular chapter. And so that is a picture of one of the chapters taking their annual photo. But I just want to point that out just to confirm that life insurance is nothing more than a club. It started with the idea of society and club. And so this is clearly a fraternal organization that became a life insurance company. And if you look at the middle image, that is the ceremony that is traditional when someone is building um, a large building, and it usually has a cornerstone laying. That is a ceremony that's presented by um, the Masons, and so you can see that the two are um, one and the same. The two are embedded with the ideas embedded in one another. Life insurance is nothing more than a club. Here's another example of um, that transition, right? The birth of the mutual society, the mutual aid concept that we're going to take care of one another. If you look top left hand corner, it's a church called Wheat Street Baptist in Atlanta. It's actually on Auburn Avenue, which was um, the financial hub for professionals in the Atlanta area during the 1800s. And that church had something called the Atlanta Benevolent and Protection Association. There's another long name. See, when you joined churches during that time, back then they paid dues, but now people pay tithe. But a part of your dues, you also were a member of a benevolent association that the church had. And so a benevolent association operates a lot like a life insurance company, but they don't necessarily have the rules and regulations. So you became a member of the church, you paid dues, and you also had a death benefit um, under this benevolent society or association. But once again, the elite is finding a way to keep people to be substandard, secondhand citizens. And so, what happened throughout the country in the formation, the state legislators began to form these insurance commissions. So, the legislator, the governor would create a commission where a commissioner was appointed, and now they have to regulate these insurance companies because they were popping up everywhere. But then they seen these benevolent associations popping up in these black churches and rural white churches. And they said, hold up. We need to put some laws in place. Now, some of it was justifiable because a lot of these benevolent societies started to become insolvent. So remember, we still had Civil War, you had uh, World War One, World War Two, and so a lot of these benevolent associations was paying out more than they can take in because a lot of their members were overseas. A lot of them were passing. And so these state insurance commissions said, you know what, you have to meet certain standards in order for you to operate like this. A benevolent society is essentially an insurance company. So the regulations we're putting on these life insurance companies that's popping up, we have to put the same on you, right? You have to create you have to create a document that explains your rates, and you also have to have a certain amount of money in escrow so we can try to prevent you from being insolvent. Well, the churches weren't in a situation to escrow $1,000 or $5,000, and so what you seen was some affluent businessmen begin to buy up some of these associations that were becoming insolvent. So here's one example um, where a affluent businessman in Atlanta on Auburn Avenue, Alfonso Herndon, who was a barber, had a barbershop in the black community as well as the white community. And he was making a lot of money because he had access to both sides of the track, per se. And so he purchased the Atlanta Benevolent and Protection Association from Wheat Street Baptist. And in fact, he bought some more and he created Atlanta Life. And Atlanta Life was one of the first African owned life insurance companies. And it made Alfonso Herndon one of the first African American millionaires. He also employed hundreds of life insurance agents for the first time. For the first time, we had African American life insurance agents that literally went out to those communities that those elite societies, that those early life insurance companies will deny because they said you had a lack of insurable interest. So they went door to door in communities, mainly in Georgia and surrounding states, and they also went into some rural communities where whites in rural communities live. Another example of this transition from club to life insurance is the Big Bethel AME Church in Jacksonville. Same thing applied to them when you became a member of the church, paid monthly dues, and a part of the dues you had membership to the Benevolent Association. But Big Bethel was able to meet the standard that was imposed on benevolent societies in the state of Florida and created a true life insurance company called the Afro American Industrial and Benefit Associates. Long name. Another example is the North Carolina Mutual and Provident Association Industrial Insurance Company. That's probably the longest one I've ever read. But that insurance company is actually the first one on record, that the first African American founded life insurance company. The name now is North Carolina Mutual, who I believe got bought out recently by Atlanta Life. So you can see it's all tied in. But it was actually founded by a barber. Okay, barbers were one of those respected professions that actually was making money in the black community, and some other business people in their um, business hub similar to Auburn Avenue. And so they started North Carolina Mutual, who also created uh, jobs for door-to-door life insurance agents that went to communities in North Carolina and rural community, the inner city community as well as the rural communities. I also want you to pay attention to the image in the top middle of the screen. Now, these clubs, these associations that became life insurance companies, um, were examples of associations and insurance companies in African American communities. But like I said, farmers, white farmers, and whites in rural communities were excluded or restricted from those wealthy societies and life insurance companies. And so they too said, we want to commit to taking care of our widows and orphans if something happens to us. So we're going to create our own fraternal organization and provide mutual aid for one another. And so they created the International Order of Foresters. Okay, so it was a fraternal organization for farmers, and they made a commitment. First they provided benefits for each other, so they met, and then you had different things like uh, education series. They will pool their resources together to get discounts on equipment, and they also made that commitment of taking care of the ones you left behind if you died. And so, as a result of that, the International Order of Foresters created a life insurance company called Foresters Life Insurance. And that company still exists today. And it can be sold to anyone. You don't have to be a member of the fraternal organizations. So you can clearly see that life insurance is nothing but a club. It started from the idea of club, association, society. And over time, it transitioned not for capitalism, but for need. Life insurance is a club. And now I want to show you the similarities. I'm going to show you exactly how they transition, how they compare. Your health qualifies you, your money protects you. See, when you join a club, you have membership qualifications. And so if you meet the qualifications that's required, you can become a member. You have to be a man to join the Masons. You have to be a woman to join the Eastern Stars. You have to be a woman to join a sorority. You have to be a farmer to join the International Order of Foresters, and so forth. On the life insurance side, your health is what qualifies you. You meet the health standards or the health requirements, we let you into the life insurance club. In the club or association world, you pay dues. Once we let you in the club, long as you once we let you in the club, and as long as you pay your dues, you maintain membership. In the life insurance world, once you meet the health qualifications and you are in the life insurance club, as long as you pay your monthly premium, your protection remains. On the club side, a part of some of the benefits you get as a member of that particular association or club, we also make a commitment in those fraternal organizations that when you die, we're going to take care of your widow or orphan because we know what happened in those wars. On the life insurance side, we call those widow and orphans that's going to be taken care of, we call them beneficiaries. In the club world, you in the club and association world, you get benefits. right? Unions were formed for collective, for wage bargaining, for other benefits, for discounts, for support. Those are benefits that you get because you join. In the life insurance world, we call those living benefits. Those are benefits that you get while you are alive. And your family doesn't have to wait until you die. Benefits while you're alive, and you still have a death benefit for your loved ones when you die. So you can see the similarities. You can see how essentially they're one and the same. Different name, but they're still the same. So now I'm going to discuss with you the types of life insurance. Once again, a part of this presentation is to break the stigma, to break the misinformation, and to try to eliminate ignorance so we can remove the veil and so people can pursue getting the proper protection for their family without these biases, without this influence that negatively impacted a lot of working class people from doing the right thing financially. There's only two types of life insurance: term, which is temporary, and permanent. Everything else is a product of these two types of life insurance. I know you heard of whole life insurance. Whole life insurance is a product, but it is permanent insurance. I know a lot of you heard of universal life insurance. Universal life insurance is a product, but it is a permanent insurance. It's permanent insurance. Term, permanent. Only two. So let's talk about term insurance. Term term insurance is life insurance that lasts for a specific term. That term can be 10 years, 20 years, or 30 years. During that term, you are going to pay a level premium to the insurance company. That means you're going to pay the same premium every month for either 10, 20, or 30 years. And in the event that you die during that term, the insurance company is going to pay your beneficiary whatever that death benefit is. So now I'm going to talk about some of the pros and the cons of term life insurance. One of the pros is that term insurance is temporary. See, you buy term insurance to meet a specific need. So let me give you two examples. Let's say you and your spouse buys a home and you sign you acquire a 30-year mortgage. And so both of you agree that, God forbid, if something happens to me, I don't want to leave that burden on you. I want to make sure that you're able to pay off the house so you won't have that burden of coming up with that monthly mortgage payment. And so both of you guys get a life insurance policy that's only going to last 30 years, because after that, the need that we got it for doesn't exist. Another example would be a person that has 2 or 3 children. One of your concerns is you want to make sure that their college tuition is paid. You don't want them to be in debt, and you don't want them to have a bunch of student loan debt. And so you say, okay, my children are 5, 8, and 11. I just want to make sure if I die before they graduate college, it's paid for. And so you might get a 20-year term, because when 20 years hit, they're grown. Um, they figured out the way to get their own financial aid, or maybe you were saving money, but you don't need it anymore. They graduated, they're grown. Term is for a specific need and for a specific time. Term insurance is cheaper. It's just cheaper. Not much to explain. Okay. Mortality tables basically is the foundation of insurance, and term insurance is kind of the foundation of all insurance. Okay. So it's cheap, right? It's cheap. Another benefit of term insurance is it's convertible. So I'm going to explain that a little later. But all that means is you can, once you get a term policy, once your health qualifies you and you are quote unquote a member of the life insurance club, you can convert a term to a permanent policy without showing evidence of insurability. I'm going to talk about that a little later. And then term also, you could have living benefits, benefits that you can use while you are alive, and nobody has to wait only for a death benefit after you die. Okay, benefits you can use while you are alive. Some of the cons of term life insurance. One, there's no cash value. So every month you're paying a level premium to the insurance company for a specific term. Let's say, for an example, you have a 20-year term, you pay every month, you reach the um, the 20th year and 1 day, the policy is terminated. The insurance company owes you nothing, you owe them nothing. You just walk away. No cash value. There's nothing to pay you. You have nothing there, right? You had coverage, you had a peace of mind during that the policy expires, you walk away, they walk away. Nobody owes anyone anything. Another con to term life insurance is age restrictions. See, the mortality table, which is a chart that it basically um, it basically uses data to determine the average age that people die. So that's kind of the basis of life insurance. And that's how they're able to determine if we're willing to take a risk, because we know that most people die at age 85 or 86. And that's how they figure out, is it worth that's how they figure out how much to charge you, and then your health plays a part too. Well, we know that the average age of death is 85, 86 years old. So the insurance company is saying that your term should not go past that time frame. So, for example, if somebody is 60 years old, the insurance company might say, "Well, you can't get a 30-year term life insurance policy because you're 60 years old. If you keep it for 30 years, it's going to put you at 90." So guess what? We won't allow you to get a 30-year term, but you can get a 20-year term. Okay? Somebody that's 75 might be restricted, period, because even at a 10-year term, they're very close to that number, 85 years old. So you're restricted because of your age. Another con is it's temporary. You get a term policy, you're 30 years old, you're 40 years old, you get a 30-year term. With a 30-year-old, that policy is going to expire when you're 60. A 40-year-old is going to expire when you're 70. And so now, when most people need it the most in the 80s, in your 80s, no coverage is there. It's not designed to last that long. It's designed for a specific time frame. Another kind, which is not on the presentation, is the health qualification. Term policies at a certain age, beyond a certain age, it is more difficult to get a term policy. Well, it's more difficult to meet the health qualifications to get the term policy. You want to join the club? You want to join the term life insurance club? Then you have to meet certain health qualifications. Oh, and by the way, they're a little strict. And that's mainly because the term most term policies have a higher face amount. Most term policies start at 50,000, 100,000. And so you're asking the company to put up $50,000, $100,000 for a small monthly premium. So guess what? We want to make sure you can outlive this 20, 30 years. As much as we can predict, we want to make sure that you outlive this. So we get all the premium and don't have to pay. That's the goal. That's their goal. So it's a little tougher to qualify for a term life insurance policy. Let's talk about permanent. Let's talk about permanent insurance. Permanent insurance lasts until you reach age 100. And for until you reach age 100, you are going to pay the insurance company a level premium, the same premium until you reach age 100. And if you die at any time before you reach age 100, the insurance company is going to pay your beneficiary whatever that face amount is. But if you live to age 100, the insurance company is going to pay you whatever that death benefit is. Hey, Steve, you reached age 100. Congratulations, sir. So instead of paying your beneficiary this $100,000, we're going to pay it to you for you to do whatever you want with it. Congratulations. Enjoy the rest of your life. See, at that point, the insurance company already knows you're going to die. You're way past the mortality uh, year, the mortality age year. So they just give you the money and you can do whatever you want with it. But there's something else beyond the permanent policy lasting to age 100 or your whole life. That's where that product called whole life was created because it lasts your whole life. But there's something else that makes permanent different from term, and it's something called cash value. See, that level premium, that premium that you pay every single month until age 100, goes into the insurance carrier's general account. It's the account that everybody's premium, all their customers' premium goes into. But then what the insurance company does, they create a sub account. They create a miniature bank account or a miniature cash value account that is earmarked just for you, and they take a portion of that level monthly premium, they take a portion of that and it goes into that cash value account. And everything in that cash value account is yours. Now, if you catch me a little earlier, I almost used the word savings account or bank account. But the reality of it is that when I explain it, even though we shouldn't use the word bank account, but to break the stigma, I just want people to realize that that cash value account is like it's like a piggy bank. It's like a savings account. It's your money. And that portion of money that comes out your monthly premium that goes to that cash value account sits there and it grows at a fixed interest. And so we're going to talk about that in the next slide. Benefits, cons to permanent life insurance. Number one, a pro, it lasts your whole life. That's where they get the product from, right? Term, for a specific term, 10, 20, 30 years, this is going to go all the way to age 100. Then you get that cash value. You get that cash value account, that miniature baby account, that miniature piggy bank that's associated with your life policy. And like I said, the money that goes in there is your money and it grows at a fixed interest. Now I want to highlight a couple benefits on what you can do with that cash value. There's several things you can do, but I just want to highlight a couple of them. Number one, you can surrender the permanent life insurance policy and get every dime that is in that cash value account. See, when you get a permanent life insurance policy, especially whole life, now there's some that there's some fluctuation, but the oldest is a whole life. So the oldest permanent policy is a whole life policy. And when you get a whole life insurance policy, you also get a illustration. So an illustration shows you your monthly premium. It shows you the death benefit that the insurance company will pay your beneficiaries if you die before age 100. And it also shows you how much cash value is in that cash value account, that's in that little miniature savings account, that's in that piggy bank. So every year to age 100, you can point and see exactly how much money is in that cash value account. And at any time, normally past 3 to 5 years, because those early years, that cash value, it doesn't accumulate. The insurance company is saying that the vast majority of those monthly premiums has to cover Steve's commission, the administrative costs associated with this policy. So that piggy bank, that cash value account, doesn't start to see accumulation until like year 3 and year 5. But after that, you can run your finger down any given year and know exactly how much is in that cash value. That if you surrender, you cancel your policy, they have to cut you a check for that amount of money. So that's one benefit, one thing you can do with cash value. The other thing that you can do with cash value, you can borrow against it. Basically, what it is that you, as the insured, is asking the insurance company, ABC Insurance, that I want to borrow money from you, and you're going to use my cash value account as collateral. So let's say that, for an example, I have a whole life policy. Now we're talking product specific, a whole life policy, and I have $50,000 of cash, $50,000 of cash value in my cash value account. And because I like riding motorcycles, I want to borrow money from ABC Insurance Company to buy me a new motorcycle. And so I call ABC Insurance Company and I say, how much cash value do I have in there? They say 50,000. I look at my illustration that I had for the last 15 years and say, oh yeah, that's correct. I have $50,000 in cash value because it's guaranteed. So that needs to be a benefit. That needs to be a pro in this. I need to add that to the presentation as a pro because it's guaranteed. That illustration, those numbers are guaranteed. So the insurance company says, Steve, you have $50,000 in your cash value account. How much do you want to borrow? I want to borrow $40,000 to buy me a new motorcycle. And so what's going to happen, the insurance company is going to draw up loan documents. They're going to give me the $40,000 and they're going to use the $50,000 in my cash value account as collateral. And so now I'm got to pay my monthly level premium because that never stops. You pay the same premium every year till you reach age 100. And guess what? Now I have a note, a loan note that I have to pay ABC Insurance Company. I'm continue to pay my monthly premium, and now I have to pay a note. But here's the beauty of borrowing money against your cash value account. See, you're not pulling money out that piggy bank, that savings account. You're getting a loan from the insurance company. So that $50,000 that Steve has in that account continues to sit there and grows at a fixed interest. And so now the interest, because the insurance company is loaning you the money, there's interest in that note that you're paying them back. And so now the interest that I have to pay back ABC Insurance with my monthly note payment is a little bit higher than the interest I'm making on my little cash value account, but it helps offset. So my cash value account is growing at 3% interest, and my note back to the insurance company is 6. So I'm only borrowing money at 3% interest as opposed to me going to the dealership and getting a loan for 7 8%. So it can be a little confusing, but your money sits there, you borrow against it while your money sits there. It's making you money. And so the money you're paying the insurance company is costing you to borrow that money, but the two offsets. Okay. It's a powerful tool. All right. Another thing, real quick, I'm going to talk about cash value account. You have the ability to do a reduce paid up. So it's simple. That same scenario, I have $50,000 in cash value in my whole life policy. That is a $500,000 face amount life insurance policy. And so now I'm 60 years old, children are grown, house paid off, investments doing great. I don't need 500,000 anymore. But I don't want to just surrender my policy. I just don't want to cancel it. So I tell the insurance company, look, I got 50,000 I have $50,000 in cash value. What I want to do, I want to surrender some of it, meaning I want to uh, get some of my money out that cash value account, but I want to leave some in there and purchase a life insurance policy that will cover me all the way to age 100. So I have $50,000. I take out 30,000 and I ask the insurance company how much life insurance can I buy from you for 20,000. Now I'm just going to give you an example because every carrier is different and they got to do the math to see if they're willing to how much life insurance they're willing to sell you. So in this example, they say, Steve, for 20,000, we'll give you a $65,000 death benefit policy that you never have to pay us a dime ever again to age 100. And then we're going to give you the $65,000 in cash, right? Pull the money out of it, and I'm buying the policy that's going to last me the rest of my life. It's called reduced paid up, or the name can vary depending on the product. All right. The other thing is the age restrictions are not as prevalent in a permanent policy. So in term, remember, if that term, that 10, 20, or 30 years is going to get you to age, your reach is going to get you at age 85 or 86 or beyond that, they might not sell you a term. You're too close. The end of that term is going to be too close. But permanent policies generally allow you to get a policy up to age 80. So you are only 5 years away from the what the actuaries say that the average person lives, and they're still willing to sell you a policy. That's one of the benefits to permanent insurance. Then you have living benefits. That means you have benefits that you can use while you're alive, and nobody has to wait till you die to see a benefit. Okay. And then you have something called retirement supplement. Basically, all that is basically what it is using that cash value to help subsidize or to help fill in the gap of your retirement plan. Now, agents have to be very careful on how they use this word because it's illegal to call permanent insurance a retirement plan. Let me give you an example. Let's say that I'm working for a company and my goal is to retire at age 65. Now, I know with this company, I have a pension. So when I reach age 65, when I retire, the employer is going to pay me a pension every single month. So I know I'm gonna get my pension, and I know I'm gonna get Social Security and reach age 65. But I have a certain lifestyle I want to live, so I want to make sure I have more than my pension plus my Social Security. And so I got a permanent policy when I was young, and I'm watching on that illustration they gave me. Every year I'm going down year to year to see how much cash value I have in that little baby bank account, that cash value account. And then I put my finger on age 65. So now I know I'm getting my Social Security every month. I'm getting my pension every month. And by the way, I'm going to have $150,000, just an example. $150,000 in that cash value when I reach age 65. Now I have options. I can call them and surrender, say, hey, I'm canceling the policy and I give me my money, or I can do all those options, but it can add to my retirement. It supplements my retirement. That is a benefit of a permanent policy. Okay. A con of permanent insurance basically is more expensive. All right. All right. Living benefits. Okay. Living benefits, like I said, is benefits that you can use that are attached to your life policy while you are alive. And those benefits are what we call riders. They're separate miniature policies that is attached to your life insurance policy that actually quote unquote ride on your policy. So we call them riders. Okay. One of the living benefits is convertibility. I talked about that when I talked about term. So basically, what that is saying that, hey, Steve, you want to join the life insurance club, so you have to meet our qualifications, which is your health. And so you fill out an application. They do the health exams. They ask the health questions. Steve, welcome to the life insurance club because you meet our health qualifications. Now, once I'm in the club and term is not enough, right? I want the insurance to last to age 100. I realize that I need more money to help supplement my retirement. Hey, this term is just not going to do enough for me, Steve. I need a permanent policy. I'm liking that whole life policy that you told me about with all that cash value, piggy bank, and all that. Okay, cool. You're in the club. You qualify health wise. All we have to do is ask the insurance company to allow you to get a permanent policy, and you don't have to show any more evidence of insurability. We can't try to requalify you for your health. You're already in the club. And the reason why that's powerful, because you can get a term policy when you are young and healthy, and it's going to be very expensive. And as you get older, if you decide to convert, you might have had an issue with blood pressure. You might be overweight compared to you where you were when you were 25 to 30. Things like diabetes, different things happen. And guess what? You can have all those health issues. They cannot ask you any health questions because you're already in the life insurance club because you met the health qualifications. That's the power of convertibility. Then you have dependent children and spousal insurance. All that is a baby life insurance policy that is attached to your policy that covers your children and your spouse. Okay. Then you have things like total disability. It's another rider that can be attached to your policy if you are uh, totally dis- totally disabled. Then the life insurance company will pay you a monthly benefit while you are disabled. Okay. Then another thing that a lot of life insurance companies have, riders they have on the policy is chronic illness protection, terminally ill protection, critical illness protection. The terminal illness protection is the one I really want to talk about. This rider exists in the vast majority of life insurance policies that are available. Basically, what that rider is saying that if you develop or contract a terminal illness, a illness that will eventually lead to your demise, and a doctor gives a statement and says that you have less than 12 months to live, you are able to request from your life insurance company some or all of the face amount while you are alive. So, for an example, somebody has a terminal illness. The doctor says you have less than 6 months to live. They can call the insurance company and say, out of my $100,000 policy, I want to get 70,000. And when I die, the insurance company is going to subtract the $70,000 and pay your beneficiary the 30. You could do whatever you want with that money. You can enjoy your remaining days, you can travel, or you can even try some experimental medicines or some experimental treatments that your health insurance company wouldn't cover. Now, again, if you pass away, they're going to deduct the amount that they paid you out of your death benefit. But let's say you miraculously get healed. The alternative healing practice or the experimental drug actually work. You are completely healed. So guess what? When you pass away, because it could be years later, when you pass away, all they're going to do is deduct the amount that they gave you. Okay. That's the power of the terminal illness rider. Critical illness kind of works the same way. You're critically ill, you can't take care of yourself. They pay a monthly benefit out of that face amount. And that face amount shrinks. Every time they pay you, it shrinks. Okay. Now, one more um, benefit that I want to discuss with you. If you look in the right hand middle section, you'll see a sheet, a grid. For those of you that bought a house or got a business loan, you had to fill out something called a personal financial statement. And what that is a statement that you give the loan officer that lists all the assets that you have. Now it has liabilities and other things, but I want to focus on asset. Okay. So you're going to list everything that you have, the cars that you own, jewelry that you own, personal items, cash you have in a bank account, because the bank that you're borrowing money against, the loan officer, they want to see what things that you possess that if you default on this loan, what can we get our hands on? One of the things that they ask is for your life insurance cash value. They want to know how much cash value you have in that cash value account, that mini bank account that I discussed when I was talking about permanent life insurance. Because that's one of the things that you can get your hands on. You can surrender the policy. Hey, in that example I used earlier, I know I can get my hand on $50,000. God forbid if it's a situation where I can't pay my bill because the business collapsed or whatever. But I'm going to show you the real power. This one of the secrets of life insurance about that line item of the loan officer want to know your cash value amount. See, a good loan officer understands that legally they cannot ask you how healthy you are. So they know if you qualify for a policy that is building cash value, they know that you were at least healthy enough to qualify for a life insurance policy. The life insurance club deemed you healthy enough to join their life insurance club. And so now I know that Steve that's taking out this loan is healthy enough to work this business or to work to pay us back. That's a little secret there. Then that tells the loan officer that, hey, Steve has a different mentality. He has an understanding of finances. So now we know he's healthy enough and he understands finances. He's a cut above the rest. That should be in your favor if you're dealing with a competent loan officer. So they don't tell you about that. That's the secret of life insurance. Okay. So this particular slide, I get kind of product specific. This is one of the carriers I represent, but I wanted you to see that when you're talking to an agent and they do a presentation, then they should have a page that tells you about the living benefits that are available to you for you to use while you are alive. Okay. The only ones I really wanted to point out on here that stands out to me is the on the right hand column is the accelerated living benefit or critical illness, and then the children insurance agreement or the children term rider. Okay. The critical illness rider, that's the general name used uh, across most insurance companies. Basically, what they're saying is that if a person contracts any of these illnesses, okay, heart attack, stroke, cancer, okay, you see all those bullet points. If you have one of those illnesses, the insurance company will pay you a certain amount of money because you had that issue. And so they're doing that to help offset your deductibles on your health insurance and just some of the costs that comes with you being in the hospital for 2 weeks, right? You being not able to work, you still have bills to pay. So now the insurance company is going to take a certain percentage out of that face amount and give the money to you because you had a heart attack, you had a stroke. Okay, powerful rider. Then you have the children insurance agreement. That's what this particular insurance company calls it. But generally, it's called the children term rider. Real simple. All it is a miniature baby policy that you can add to your policy for your children. But what makes it unique is that you get that rider in the form of units. What that means is you are not necessarily saying, okay, I have three children, Bob, Kim, and Will. Bob, Kim, and Will. And Steve, when I get this policy, I want to put a policy on Bob, then I want to put a policy on Kim, I want to put a policy on Will. No, you buy units. And what the units will be, let's say one unit is equal to $5,000 in death benefit. One unit, $5,000 death benefit. So let's say I tell Steve I want to get 2 units. 5 plus 5 is 10. I get a children term rider on my main policy of 2 units of children term riders. That's $10,000. But basically, it's $10,000 for all three children. So if one pass, insurance company is going to pay the beneficiary 10,000. If two passes together, they're going to pay 10,000 plus 10,000. That's 20. Okay. And then it doesn't matter how many more children you have. So you can have 4 more children. It's 5 available for each one. And if God forbid, if all of them pass, God forbid they pass in a fire or a car wreck, you're going to get 5, 5, 5, 5. Okay. That's the power of term. That's one of the benefits of a child term rider. The other thing, this is another one. That child term rider is also convertibility. I'm sorry, that child term rider also has convertibility. So remember I said earlier that one of the benefits of term, you can convert it. You qualify for you meet the health qualifications. They let you in the quote unquote life insurance club in the into a life insurance club with a term policy, and then later on you're like, hey man, I want more benefits. I want to transition, convert to a whole life. Well, the same thing can happen for a child term rider. When that child reaches age 23, depends on the company, but usually it's an age that a they choose an age that most children will be out of college and they can work for themselves to pay for their life insurance when they truly become independent. Okay, a lot of contracts deem um, young adults that's still in college as still dependent. Okay, so when that child, when your children reach age 23, they're able to call ABC Insurance Company and say, I want to take this $5,000 policy that's been attached to my dad's policy and make it my own. And they don't have to show any evidence of insurance. The insurance company cannot ask any health questions, even though they're sick, even though they might have contracted a disease. They can't ask them any questions because they're already in the club. They joined the club when they were writing you. Well, okay, let me change that. When they were writing on your policy, they were already in the club. Some companies allow them to do a multiplier, right? Will the child turns 23, calls the insurance company, hey, I want to get mine. I want to convert this term into a permanent policy. They can't ask you any health questions. Oh, by the way, I want to take this 5 and make it 15 because my dad said in the contract, y'all said I could do a multiplier in 3. They can't ask any health questions, even though he has sickle cell. Can't ask him any questions. And that particular child will catch heck getting life insurance on their own with sickle cell. So now because you got a rider for them 20 years ago, he has access to a permanent life insurance policy because he's able to use the convertibility that's embedded in the child term rider. But in this case, the insurance company calls it children's insurance agreement. So now that that's a lot that I thrown out you. The other thing about this particular product, now some carriers do that, but this particular carrier with this product in that agreement, if the primary insured, the parent that has the policy that added their children onto their policy through the child term rider, if the primary insured, me, passes away, those children's that $5,000 is paid up to age 23. So no matter if they're 5 when I get the policy, 10, God forbid I die, my beneficiary will be my spouse or whoever still gets the check. And then those children have that $5,000 policy apiece until they reach age 23. Then they can call the insurance company and do the convertibility. Okay, it's a lot. Powerful, powerful, powerful. You should, if you have children, you need to add a child term rider because it is dirt cheap. Might be $2 a month per unit, $5 a month per unit. Okay, my opinion, max it out. If you can afford it, max it out. Get as many units as you can. It's still probably going to be less than $10 a month. All right, so which one is better, term or permanent? Okay, I want you guys to hear me out. If any person, any professional life insurance agent tells you that one product is better than the other in a general statement, in a presentation, on social media, without knowing who you are, without knowing the details about you, without knowing your health situation, how can they tell you which one is better than the other and they don't know anything about you? How can they say buy term and invest the rest? How can they downplay permanent insurance? How can they downplay term insurance and they don't know anything about you? Buyer beware. The only way I can inform you or any professional life insurance agent can tell you which one is better, they need to sit down with you. They need to talk with you. They need to know your health qualifications. They need to know what your goals are. They need to know what your needs are. I'll be happy to discuss with you which one I believe is better for you, and then we can create a plan together. All you have to do is text me. Text my agency at 770-679-2499 and type your name/life. You're going to text me at 770-679-2499. For those that's listening and not watching, text me your name/the word life. We'll reach out to you. We'll set up a time. I'll be happy to share my knowledge with you. If you buy or don't, I've been doing this 22 years and I've been doing way more educating than I have selling. So helping out another 15, 20 people is not going to hurt me at all. Next question we always get. How much life insurance do I need, Steve? How much life insurance do I need? See, when I first got my license in 2003, I went through a life insurance training for the company I was representing. And then I went to another one when I went with another company. And I had a lot of training on both sides, property and casualty, selling auto insurance and life insurance. But one of the things that these companies always do is they teach you a method called doing a needs analysis. And what that is a paper or it might be something on the website where I'm helping the customer figure out how much life insurance they need by asking them a series of questions. Questions like, what's your income? And you should leave a certain amount to your spouse when you die. And how many children do you have? Do you want them to go to a four-year university, in-state university? And at the end of this presentation, you will have a suggested amount of life insurance that this person needs to purchase. Here's the issue I have with that concept. It does not matter who I am sitting in front of if I use a needs analysis, which I think is a great thing to do if you're dealing with certain clientele. But it doesn't matter if I'm sitting with a single parent that works at a factory or a single parent that is driving, ride sharing is their living. Doesn't matter if they're 26 or 76. I guarantee you, if I do a needs analysis or the average agent that went through these training programs does a needs analysis, is going to say that that person needs between $500,000 to $2 million every single time. I can come up with a needs analysis that somebody working at a fast food joint that they need $500,000 to $600,000. It seems like you're doing the right thing, but this is the problem. I do a needs analysis. I come up with $500,000 for somebody who's only making $38,000 a year. They're 45 years old. And then I show them the amount it's going to cost on a monthly basis. And this person looks at that amount and their eyes get big because they cannot afford the amount that you presented them to get this $500,000 life insurance policy that you told them that they needed. And then they tell you they cannot afford that. And so what this agent does, he follows the process. They teach them in the training. Now, some of them will tell you, well, you shouldn't even do business with somebody that can't afford it. But that's a whole nother subject. But then they tell you, well, you need to keep, then the agent will keep going down. And then they say, okay, well, based on what you're telling me, you can't afford 500,000, but you surely can afford 60,000. And so now this person is like, you're telling me I needed 500,000, and now you're trying to sell me 60,000. I think I said 60 earlier, but 60,000. It feels like a bait and switch. And so people say, you know what? I'll think about it. And so now they went from You saying they need 500,000 to not having anything because you were trying to sell them too much life insurance because you wanted to make big commissions. Some of these people, and as a professional, you should not even offer anything. I'm sorry, you shouldn't even offer them anything that's that high. Because if you would have spent time talking with them and understood their needs, their wants, you would have done the right thing. And so now, everybody that's listening to this presentation, everybody that's watching this presentation right now, without knowing you, without answering you any questions, without knowing your situation, I can tell you right now how much life insurance you need. Now, I just contradicted everything I spoke about, but I guarantee you I can give everybody the right answer right now on how much life insurance you need. You need as much life insurance as you can afford. See, it does me no good. It does you no good for me to sell you a life insurance policy that you can't afford. You're excited to see this $500,000 policy. You're going home bragging and you feeling confident, but a year and 3 months later, you cannot afford it. So you let the policy lapse. And so, guess what? For a year and 3 months, you know what you did? You just donated money to a multi-billion-dollar company. Because when you need coverage, you're not going to get it. And all that premium that you paid, you see no benefit. So it does me no good to sell you something you can't keep. And what does you no good for me to sell you something you can't keep. And it does me no good because I didn't help you. So I'm going to give you a little secret. The agent's commission, when they sell you a life policy, the vast majority, like 90% of what he or she gets paid is on the first year of your policy. After 1 year and 1 day, in most cases, they don't care if you cancel it or don't, because they're not going to make any more money off of you. So that's why they don't care about selling you a $500,000 policy and you keep it for 1 year and 3 months, because when you let it lapse, it doesn't hurt his pockets. So I'm exposing that. I'm trying to open the veil. I'm trying to attack the stigma, so you can know the truth. Get what you can afford, and don't be ashamed to tell the agent how much you can afford, because I promise you, he or she can get you something. I promise you, they can get you something close to that amount. Now, if you tell the agent all you can afford is $19.14, okay, he or she is being honest with you. I can't help you. Okay? Get as much as you can afford. All right, going to get through this pretty quickly. I'm going to talk about another life insurance product, but it is an indemnity product. Basically, it's accidental death and dismemberment. And this particular company, American Amicable Group, is product specific, but accident, death, and dismemberment policies exist. Okay, they exist with different companies. Basically, what it is that if you die from an accident or you become dismembered, okay, life insurance conversations are morbid, but that is what it is. You lose an eye, you get a certain amount. You lose a limb, you get a certain amount. If you die due to a covered accident, drowning, car wreck, motorcycle ride, you fall off a ladder, break your neck, you die, your family's going to get a certain amount. Okay. If you reach out to me, you text me so we can talk. 770-679-2499. Text me your name / life. Okay. I'm going to give you a no cost accidental death and dismemberment life policy, $5,000 policy for everybody that's seen this presentation. Okay, right? I'm able to offer 1,000 to a limited people, but I'm able to, the insurance company is allowing me to bump it up to 5,000 for a limited time. We're not in the business of handing out free policies. So I got a certain threshold that I have. That's nothing for you to worry about. That's for me to meet that standard. But for those that want it, reach out to me. If you're in a state that I'm licensed in, which I'm licensed in several, we sit down and talk. You're going to leave there with a $5,000 accidental death policy. Won't cost you a dime. Text me. All right, I'm going to some Q&A real quick. Getting down to the last 2 minutes. One of the biggest questions I get, Steve, I have health questions. Can I still get life insurance? Steve, you said that my health qualifies you. Well, I got health issues, Steve. Answer is yes, you can. Yes, your health does qualify you. But I try to use companies that do not do medical exams and have liberal underwriting. Basically, what it is when you call traditional life insurance companies, after the agent writes the policy, they send a paramed to you or you go to them. Okay, they're going to do I love using this word baby, this baby miniature and miniature, this baby miniature physical. They're going to do your height, weight, they're going to draw blood, they're going to check your urine, and in some cases they do an EKG. And they might go a step further and ask for medical records from your primary doctor. And then they're going to underwrite. Then they're going to decide, was that amount of money that we charge you enough? Do you even qualify? And we might need to ask for some more money. That's why I stopped selling it, guys. I got a lot of pushback from people, and the people I did right, they came back with a bunch of, oh, you have this, you have that. We gotta, instead of you paying $50 a month, now it's $125 because you have quote unquote pre diabetes. Got tired of it. So I use companies that say, hey, we're going to be a little bit more liberal. We'll take a little bit more risk. And guess what? We're not going to do all that blood work or none of that. We're going to ask you some questions. We're going to do a prescription check and an MIB. So we're going to pull a prescription check to see what medicines that you've been prescribed. So it don't matter what you tell me on the application. I know if they gave you congestive heart disease medicine, then you probably got it. Okay. Then we're going to do an MIB that tells us when you went to the doctor, basically when you got surgeries. And we're going to use what you say. We're going to use that Steve is looking at you and asking you questions. We're going to look at what you said on the application. We're going to look at these four. We're going to let you know out the gate, do we want you? Period. Not going to charge you more. We're just going to say we'll write you or we won't. Okay. I have companies that will insure 99% of the people that's listening to this, watching or listening to this presentation. Even if you have that and that and that, 99% of you I can get covered. I can get covered. All right. How much does it cost, Steve? Life insurance depends on your age, the amount of coverage, a lot of factors. But I can tell every single one of you, despite me not knowing your age, knowing your health, knowing where you're located, not even knowing what your sex is, I can tell you all how much it's going to cost you. It's going to cost you at least $4,000 or $10,000. Now you thought I was talking about the cost of the life insurance. See, in the state of Georgia and most states in the union, you can't just bury one of your deceased loved ones in your backyard and throw a marker on the or headstone on the grave. See, in most states, you have to call somebody like me because a funeral director is the only one that has the right for disposition. Even the law enforcement can't bury somebody. Your doctor can't bury somebody. They have to call up somebody like me, a person that has the legal right to um, to dispose of a deceased body. And funeral homes are going to charge you at least $4,000 for cremation because you have to dispose of the body. You're going to pay at least $4,000. Or if you do a traditional funeral, it's going to be around $10,000. So you're going to pay a funeral home either $4,000 minimum or $10,000 minimum, $4,000 minimum for a cremation or $10,000 minimum for a funeral. So the question is, are you going to leave that cost to your family? Because somebody's going to pay it, or you're going to do it on the front end. That's how much it's going to cost you. Steve, I have life insurance at my job. Do I really need more? Real simple. If your job includes the life insurance in your salary, meaning you do not pay a dime for it, you do not own that policy. They do. And at any given moment, every year or couple of years, that life insurance company has to do an RFP. They have to bid on it. So they have to bid with the government job that you have, or um, even the public sector job that includes it into your insurance packet. That insurance company has to bid to get that contract. And your employer pays them every month for that package. But at any point, that insurance company can say, "Hey, man, you got all these employees, and the last couple of years, I don't know if it was COVID, I don't know what it is, but we've been paying out too much money. We can't charge you that amount we've been charging for 3 years. We got to go up 50%." So now your employer and the board sits around and say, "Look," the benefits team say, "Look, ABC Insurance and this whole group life thing, they want to up the price on us." Then they're having financial issues. Business not what it used to be. They can't afford it. Guess what? They decide to take it out of your benefits package. They have the right to. It's their policy. You're just the person that's insured. So now you don't have any coverage because you relied on that. The other thing is, let me ask you, are you going to retire there? Now, I know every life agent that you spoke to said that, and it's a fact. That's why they say it. If you're not going to retire there, then you can't count on that policy because the next job might not even offer it. Okay. Next question. How much does Social Security pay? Okay. Military vets have certain death benefits. I am not going to go over that because there's a lot of moving parts, when they served, if they're serving, a lot. But this is what I can tell you. I'm in the funeral business, and I rarely hear about a veteran passing away and their families coming in with documents, and the funeral home is getting any amount of money that means anything. I just have not seen it. So I'm not too sure what is preventing that. I don't know if it's when they served or how long they served, but I very rarely hear about a funeral home getting 800, 1500, or whatever that number is on these advertisements from the United States government. But what I do know is the vast majority of people that was inside of the Social Security system that worked at a regular W 2 job, when they pass, their family will get the death benefit from the United States government Social Security Administration of $255. The same $255 that the Social Security Administration implemented back in 1954 as a death benefit, when funerals only costed $700, now they cost $7,000, $10,000, $20,000, and the United States government is still going to give you the same $255. And that's just enough to cover the programs. Now, some of you guys call it obituaries, and the casket spray, the arrangement of flowers that go on top of the casket. Now, that is a benefit from your United States government. Steve, is this a waiting period? I get this almost every time I do a presentation. This is one of the misinformations that creates a stigma, that just creates an add to this idea that life insurance is crooked. And so guess what? People don't get it. No matter how much I try to break the stigma, people still are perplexed, and it's just embedded in their thinking. So I'm going to answer the question. There is no waiting period for traditional life insurance. I repeat, there is no waiting period with traditional life insurance. Now, I'm sure there's an anonymity out there. There's something weird. But traditional life insurance, there's no waiting period. What they are talking about, well, there's death benefit at the time of issuance. Let me repeat that. There's protection, there's coverage day one when you get 99% of regular traditional life insurance. But what people are talking about is a graded or modified life insurance policy. And it's always, I can use the word always, a permanent policy. See what it is, remember I told you your health qualifies you. In order to get in the life insurance club, yeah, I think I might have said health insurance a couple of times. But to get in the life insurance club, your health qualifies you. So the insurance company has certain health qualifications, and let's say that you don't qualify or you are borderline to their requirements. So ABC Insurance Company will say, you know what, sir, we'll let you in the club, even though you are borderline, um, what we consider not as healthy as everybody else. We're sure we'll let you in, but we have one stipulation, sir. You're not going to get the same death benefit as the other person that just qualified for this life insurance plan that just joined the club right before you because he was healthy. So what we're going to do with you, because you are not so healthy, we're going to say that you're not going to get the same death benefit. You're not going to get access to the same death benefit. Your death benefit is the same as the person that was healthy. You are not healthy. You have the same death benefit as him, but your family's not going to get all of that day one. So what we're going to do is you're going to start off at zero. Yeah, you're going to start off at zero, but as soon as we get your payment, as soon as your payment reaches our general account, you're going to start having coverage. And every single month, that protection increases every single month until you reach the 24th month in one day. And at that time, you get the access, your family's going to get the total amount of that death benefit. Oh, but because I understand it's kind of, you feel a little bit unfair because you didn't do anything to make yourself unhealthy. I mean, unless your lifestyle did it. But I understand it goes up every single month. In 6 months, you only got just an example. You got $3,000 of death benefit, or you got $1,500 of death benefit, while the other person has 25. The other person has 25,000. I get it. So this is what we're going to do. In the background of this policy, we're going to give you an accidental and death and dismemberment policy. That policy that Steve talked about a couple of slides back. So we know that the health you didn't qualify. You really didn't qualify for the next day coverage like the other person did. So we let you in, and so it's going to be, the coverage is going to be small. It's going to get bigger each month. But what we're going to do is, because our qualifications is health. Well, if you die in an accident, that has nothing to do with your health. Just because that other person was healthy, that doesn't make him not accessible to a car. Dying in a car wreck doesn't make him vulnerable to dying in a less vulnerable from dying in a car wreck because he or she is healthy. So guess what? We're gonna give you the same protection he has. Day one. Your diabetes, your high blood pressure, your weight has no bearing. Well, in most cases, has no bearing on the fact that you drown. So we're going to give you day one accidental death and dismemberment. So that's telling you what you believe, what is spreading around in our communities is misinformation because there is no waiting period. You have coverage day one. It's just not the coverage that you may want day one. And you have to wait 24 months and one day to get all of it. Got to break the stigma. Got to remove this in my opinion, um, this systematic thinking, because the divide between the elite and the working class people still exists. We know this. We see it every day in the news. We experience this. So you think that mentality just disappeared in the last 150 years? No, it still exists. It's just a different name, right? The qualifications then went from you being elite to, oh, you got to be healthy. Oh, we're gonna charge you different because you're a man versus a woman. Yeah, that's how it is. And it's going to get worse, people. So you need to understand how it works, where it came from, the benefits of it, right? Things to look out for. That's why I'm here. That's why I'm doing this. All right, last one. Last one for today. Can I put life insurance on someone else? You cannot. You cannot put life insurance on someone else. We say it in our communities every single time. We hear it all the time. I know you have a nephew or a niece that lives a lifestyle that you don't particularly agree with. Yeah, you have a older person in your family that you're going to probably be the person responsible to pay for their funeral or their cremation when they die, or you have um, someone in your family, a child in your family, whatever, that you are raising your kid, your grandkids, and if something happens to them, you want to make sure that you got revenue to take care of the kids. I know. And so you think, I need to put some life insurance on her. I need to put some life insurance on them. You can't. That person has to want it. They have to answer the health questions. They have to their health has to qualify them. They might have to do a physical, and they're going to have to sign the paperwork. But here's the caveat. You can own the policy, you can pay the policy, and you could be the beneficiary. So you can own the policy. They answer all the questions. They do the exam, or if in my case they won't do an exam, but they do whatever it takes. They qualify for the policy. The policy is issued, but your name is on it. You own it. So if they decide to get married, they decide to move, or they might call an insurance company, rubbing their palms together. Yeah, I want to see how much cash value. I seen the paperwork that dad had laying around, and I seen that illustration thing, and I seen a bunch of 10,000, 30,000. Let me call ABC Insurance. Hey, this is Michael. Trying to use a universal name, but this is Michael. I seen the insurance policy, and it had my name on it. It had my dad's name. I was kind of wanting to see about that cash value, y'all. Excuse me. Who are you? It's not your policy, sir. You need to go talk to you need to talk to the policy owner. It ain't your policy. Then you can pay for it, because they don't have a job, or they don't want anything to do with life insurance. You can pay for it, and guess what? You make yourself a beneficiary. So they can get married, they can do whatever. They can't even call the insurance company to change anything or to ask any questions. But they have to want it. They have to want it. All right. So again, if you were on this presentation and you want to take advantage of a benefit, get a no cost accidental death and dismemberment policy. You pass away due to a covered accident, car accident, motorcycle accident, slip and fall. You on an airplane. You whatever it is, your family's going to get a death benefit of $5,000. And only thing that costed you was to text me at 770-679-2499, because some people are listening to it. 770-679-2499. Type your name /life. We're going to reach out to you. And just because we talked, asked you some questions, gave you some illustrations, if you buy, great. But at least you're going to leave there with some knowledge, and you leave there with a $5,000 no cost accidental death and dismemberment policy. But it's only for a limited time. So this insurance company is not in the business of handing out policy. And when I reach that threshold, it's over with. So even some people might text me. I say, hey, you're the 60th one that reached out to me. I'll reach out to you when they give me authority to continue this offer. Okay? Hope I helped you. Hope I opened your eyes. I hope I start removing some of the stigma, because some of that stuff, it requires a lot of financial literacy. It's going to take you to really focus on that history that I talked about. Okay? There's no reason why people in our community in the 1870s, in 1880, in 1903 was getting life insurance or benevolent coverage through their church, through these other organizations, and they weren't making a fraction what we're making relative. And yet we have people that are spending thousands of dollars a month on stuff that does nothing for their family when they pass, but we have a problem getting protection. They did this 150 years ago, straight out of slavery, straight out the fields of rural Georgia, of rural Indiana. They took care of their families with a lot less resources. You have the resources, and we're letting these things that's on this Q&A deter us because, in all honesty, you're not selfless. You're selfish. And that I can't teach out of anyone. And that nobody can help. You have to, it has to, it has to come from within. But when you have a selfless mentality and you want to know more, text that number. You guys have a good day. Hope that helped you.